when one factors in political concerns or at least uncertainty, and then you have the uncertainty of what inflation is doing, what the Fed's going to do, how do you measure up those risks?
I think, there's three factors driving the markets right now. First is seasonality. Second, of course, is the election, and then the economy. So second half of September for the past 4 years in a row on average tends to be the worst period for the markets for the year. So we're just approaching that, and look where we already are. The election, I think, creating some uncertainty, mostly around expiration of tax cuts. And what will that mean in terms of inflation? Could cost up to $4.6 trillion to renew those for whichever candidate wins the election. But I think the real main event is the economy. Inflation coming out today, higher than expected with CPI, driven by shelter. People are worried that the economy is slowing and inflation isn't slowing fast enough. It holds the Fed back. I think we get 25 basis points this month for a cut. And then we may have a slow start to Fed cuts if inflation remains sticky. And that is concerning because economic data is slowly moving to the downside.
What does that mean, therefore, around one's portfolio? Diversification key, but people have been putting so much money into 7 key names when it comes to technology. Does tech continue to outperform?
I think tech will outperform as rate cuts accelerate. We can break down tech into 3 buckets: semiconductors, software, and mega caps. So software has been the laggard year to date. That's where we're most interested. We think there's some attractive names there. It's under-owned by portfolio managers. Market-leading companies like Microsoft and Salesforce. Salesforce in particular looks kind of cheap on a valuation basis. People could, as rate cuts happen, could start spending more on their products. Semiconductors, probably a little more downside to go. In a typical downturn, that segment goes down 30 to 40%. We are not there yet. So I think semis, as we approach 2025, we could see an inflection point, as 2025 could be when people start a replacement cycle post-COVID. And then mega cap, you need to be selective. We have Meta and NVIDIA dominating returns this year. I think people are waiting to see monetization of artificial intelligence for some of those companies, return on investment. So mega cap, you need to be selective. A company we like is Apple, where it's a low capex play for them to get AI into their phones. That iPhone replacement cycle is slowly starting this year. We'll pick up next year as more AI is into those phones. I think Apple is the attractive play in mega cap.
Saira, do those themes you've outlined continue through the second half of the year into next year, irrespective of the outcome of the election? I'm particularly thinking about the mega caps and your commentary on the chip sector.
I think, first of all, on a macro basis, inflation and the economy will continue to be themes throughout this year. I think for semiconductors, the biggest reason for them to inflect will be a replacement cycle for the stocks. Whether we're manufacturing and global supply chains and onshoring versus offshoring could be somewhat of a bigger issue depending on which candidate wins. Software, I think, is more of a rate play, and as companies start to spend more on software and the stocks evaluation. So I think mostly it's the fundamentals that stay intact, and which candidate wins the election doesn't have a huge impact on them. But it could have somewhat, because we also have to worry about regulations and the degree of regulations on some of these mega cap companies.
Sarah, I sat on my sofa like everyone around the country, hoping that AI would come up in the debate. The question for markets is, how much longer does this trend have to run? Listen to what Mike Wilson said on Bloomberg Television earlier today.
We just got overcooked on the whole AI theme. It doesn't mean it's over. We've written about this extensively. We're not believers that this is going to change productivity materially in the short term. That's a long-term story.
And that's why I asked you about the election. Does it happen irrespective of the outcome? Do you agree that this AI trade's overcooked right now?
Well, it definitely became overcrowded from an investment point of view. And with any new structural change in the technology landscape, like artificial intelligence, which I think is here to stay, there's going to be fits and starts. And what people have been worrying about since the July 10th peak is where are the signs of monetization and what is the return on investment on this tens of billions of AI investments that technology companies have made and that companies are making in order to improve their revenue growth and improve their efficiencies and productivity. That's what we're not seeing yet. So I think we are in a bit of a plateau or a pause for these stocks until we start to see more clear signs of what it really means and the impact on businesses. Not surprisingly, consumer technology companies are seeing positive impacts from AI, like Meta with its targeting ads on Instagram, and also Amazon, which is targeting what people more efficiently should be buying. But in other areas like manufacturing companies, we're not seeing the yield increases yet. And I think that's the other non-tech areas of the economy is where we want to see that impact of artificial intelligence.